Okay. Hello, my dear future chartered accountants. I hope you are doing great, and I hope that you making the best use of the classes which have been uploaded so far. It's almost 1 week over. The basics I would have covered. Then bond valuation, security valuation, fixed income securities was also covered. So I would like to address the doubts relating to that portion. First, let me address the doubts which I've got in my Google form, and then I'll take up others which are available in the comment section in the live session now. Okay, so let me address the doubts which I have received so far. And some of the doubts were, I don't know whether to read or not, like no doubt, just thankful, and all SFM, all problems are doubtful. Regarding PDF material, once you do a registration, you will get the link. You will get the material from our team. You may not get immediately, so just wait for maybe 1 or 2 days, then you will get it. If not, you can contact the number I have shared in my Telegram channel. There you will get it. Okay, so let me address certain questions which I have received. Exact meaning of required rate of return. Coupon rate is cash flow. Then what is different from income? This is one concept you have to be very clear of. The word cash flow and the word income, they are not same. Let me just give a simple example to make you understand the concept. Let us consider a bond with 1 year maturity. A bond with 1 year maturity. So today market price is, let's say, keep it very simple, 100 rupees. And after 1 year, it is redeemable at 110 rupees. And they also pay coupon of 8 rupees. Now, in the given case, can we say that as an investor, my income is only 8 rupees because coupon is 8 rupees? No, right? My income is coupon 8 rupees, and from 100 to 110, that means that is also my income. So my total income is 18 rupees. That is the difference between a coupon and a income and cash flow. So in financial management, the coupon, when use the word, do not treat that as income. Your income is the combination of two things. One, the coupon, what you receive, and the difference between the investment and redemption amount. Difference between those two and the coupon, of course, that should be spread across number of years, and that should be expressed as a percentage of investment and so on. I hope you got the basic difference between a coupon rate and a required rate of return. Coupon rate will only consider the coupon cash flow, whereas required rate of return considers a coupon income as well as the difference between what I've invested and what I'm going to get in the form of redemption or in the form of sales when I sell bonds. I hope that doubt is addressed. One doubt regarding YTM formula, approximation method, whether tax is considered or not from the coupon point of view. So in the approximation method, if I write the formula quickly for your reference, one is coupon or whatever the amount interest income plus redemption value minus the market price divided by n whole divided by redemption value plus market price divided by 2. So in this case, what you can do, if you want to do post tax, the coupon you can multiply it by 1 minus tax rate. In the redemption value, you calculate the tax impact and take redemption value after tax. How do you calculate post tax impact? So redemption value is nothing but sale proceeds minus the cost of acquisition, maybe market price. That will give you capital gain. And on capital gain, you might pay some 10% tax, whatever the rate of tax, that is the amount of tax you get. So from the redemption value, you subtract this tax amount. This will be your after tax redemption value. And that is how the tax impact will be considered while computing YTM. Next, in study material, there is concept of Macaulay duration. Macaulay duration is nothing but the duration, what we covered, right? That is product of year column multiplied by present value column, summation XW divided by summation W. We calculated Macaulay duration, right? That is what is duration. And we calculated duration, and that is same as Macaulay's duration. In valuation of treasury bills while computing investments, they are taken 365 days instead of 360 days. That is a differential aspect. In fact, that depends on actual contract in a real time. So in examination, you can either take 360 days or 365 days. If question is silent, you can give a appropriate assumption. Forward rate of zero coupon bond is asked in Jan 21. What is the concept of forward rate in zero coupon bond? Forward rate is discount rate, right? So whether it is zero coupon bond or regular bond, it is same. So if it is the 3-year zero coupon rate, then how are you going to calculate? Let me give a quick example. If it is a 2-year zero coupon bonds, then how are you going to calculate? The present value will be no cash flow, no coupon. So only thing what you're going to get is redemption value, which will come after 2 years. So you discount by 1 plus forward rate of year 1 plus 1 plus forward rate of year 2. And if it is 3-year zero coupon bonds, again you will have no coupon in between. What you get is only at the end, that is redemption value by 1 plus forward rate of year 1 into 1 plus forward rate of year 2 into 1 plus forward rate of year 3, and so on. So that is how forward rate concept is covered in zero coupon bonds. I think these are the questions which I had got in the material. One more question was there. While calculating the duration of the bond, we have taken present value as weight and multiplied by year. For example, 1 into PV of cash flow, 2 into PV of cash flow, like that. But when we discussed about the basics, you took the weight as number of times that a particular data is occurred. Okay, so this is regarding the concept of weighted average. How are you actually applying in calculation of duration of bond? So for that purpose, let me quickly repeat the basic concept of weighted average ones. Okay, so one column will be X, other column will be W. If I write X as, let's say 7, let's say salary of, let's say 5,000 rupees. Weight is basically number of employees, for example, let's say that is 30. And when I multiply it by this, that is X into W, what is the interpretation? 5,000 is the salary of 30 people, each of those people. So when I want the total amount, I multiply. Weight means number of times something is repeated. So here, number of employees, each employee will have so much amount. So there is number of times repetition. And therefore, in that context, what is the case of duration of the bond? So duration of the bond, the formula is, that is what is Macaulay's duration as well, summation XW divided by summation W. And what is X and W? That year column. 1, 2, 3, 4, 5. This year column will take it as X. Then we will have cash flow, that is in the form of coupon and redemption value, then discounting factor at YTM. Then I multiply cash flow with discounting factor. What I get is discounted cash flow, or also called as present value. And this total present value, nothing but market price of the bond, because discounting rate is YTM. Now this discounted cash flow, I'll take it as W weight. Why should we consider the discounted cash flow as the weight is the contention of the doubt here. Stick to basics. That's always the key to understand the concepts. And try to think as simple as possible. The problem, I think, in general is we try to understand too much. We go at the top. I think it's better we come down. What we are trying to calculate? Duration. What is duration? It should be expressed in period, time period. In this case, it is number of years. What is the concept we are trying to understand? Basics, stick to basics. I have made an investment in the bond, correct? That is my market price. That is my investment. That is my outflow. Now the question I'm trying to answer, when I'm getting the money back, year 1, I receive one amount. Year 2, I receive one amount, coupon. Year 3, I receive. And last year, I receive redemption value. So, in so many years, money is coming back. Money is not coming back in 1 year. So, when so many period of time is there, what should I do? I need to take an average. Now, what is the X column? The foundation, basics again. In general, when I use weighted average concept in mathematics or statistics, in general, X is what I would like to calculate. Weight is the importance I give. X is the basic variable. If I want to calculate average speed, X is speed. If I want to calculate average salary, then X is salary. If I want to calculate average marks, and then X is marks. In this case, I'm trying to calculate average duration. So what should be X? Duration. That is number of years. I hope you understood the logic behind why we take column X as the duration, or column year as X. Now, why should we take DCF as weights? Okay, now year 1 I receive something, year 2 I receive something, year 3 I receive something. So can I calculate simple average? 1 plus 2 plus 3 divided by 3? No, right? Why? Because first year amount is different, second year amount is different, third year amount is different. So here amount is playing the character of importance. The amount is playing the character of weight. So the variable, which is the time period, multiplied by the weight, which is the amount. And therefore, year is taken as column X, and the DCF, the amount, is taken as column W. And that's how the basic of summation XW by summation W is used for calculation of duration. I hope I have addressed that doubts. So, couple of doubts which I'm getting in the charts option here. Explain about realized yields. Okay, let me explain the concept of realized yield. To explain the concept of realized yield, I have to revise the concept of YTM, yield to maturity. What is the concept of yield to maturity? At year 1, I receive some coupon. I'll just call it as cash flow. Year 2, I receive some cash flow. Year 3, let's say I receive cash flow as well as redemption value. These are the inflows. And this, if I discount it, what I get is the market price. Now, the discounting rate, the rate at which I should discount to get market price, and that is YTM. Okay, so the discounting rate at which the present value is equal to the market price is called as YTM. Another way of interpretation of YTM is I receive the cash flow, which is coupon. I put it back in the investments, in the same bonds. Second year, I get back the cash flow. Again, I put back the amount to the bonds. So my cash flows, interim cash flows, are assumed to be reinvested at YTM. Let me explain once more. Couple of questions, let me answer it quickly. Opinion about Adani crash, let me handle separately. I'm sorry, I will stick to examination at this point in time. That's the purpose of the free classes and this clarification. Practical things I'll handle separately. Material, you have not received it. I'm extremely sorry. Please contact our office. I'll share the number also in the description after the video, and you can message in the telegram, in my telegram group. I'll share my office number. You can contact them. They'll make sure that you will get the material. Okay, now YTM, let me explain once more. I'm coming to realized YTM. Just give me 2 minutes time. Okay, year 1, year 2, or I'll just write like this: year 1, year 2, year 3. Okay, year 1 I'll get cash flow. Year 2, I get cash flow. Year 3, I get cash flow, I mean coupon, plus I get redemption value. So now, these interim cash flows, what you have now, you convert it into future values till maturity. How do you do? From year 1 to year 3. That is, year 1 to year 3. How many years interest you get? You are investing at the end of year 1 till year 3. So 1 to 2, 2 to 3. So 2 years you get. So how do you calculate the future value then? Whatever the coupon amount you get into 1 plus YTM to the power of 2 years. Now this second year to third year, whatever cash flow you get, 1 plus YTM to the power of 1 year, because second year and you're investing, only 1 year you get. And third year is you get whatever the amount you get, that is cash flow plus redemption value into 1 plus YTM to the power of 0, because you're investing at the same point in time. This is the future value, and present value is the market price, right? So one inflow, one outflow, and number of years is 3 years. So if you use the concept of compound interest, future value equals P into 1 plus R to the power of N. F is future value, what you calculated. P is the current market price, and R is the rate of interest and is number of years. So if you calculate the R inside this formula, you know what you get? You get YTM only. That is the basic assumption of YTM. So YTM assumes all these interim cash flows are reinvested at YTM. It's a basic assumption of IRR also. But this is a debatable assumption. Why? Because after year 1 cash flow, when you reinvest, the opportunities may not give you same YTM. Market rate is a dynamic subject, right? Lot of macroeconomic factors will come. Russia-Ukraine war will happen, Adani Enterprise news will come, budget will come, RBI interest rate policy will come, UK interest rate policy will come, US Fed will come. So lot of changes will happen. So after year 1, when you reinvest the bond income, the coupon, you may not reinvest it at same rate. So when reinvestment takes place at a different rate, your actual income realized, your actual yield realized also will be different. That is the concept. So let me just quickly explain how the calculation process works. So we write the formula format like this: year, like 1, 2, 3, 4. Example purpose, I'll take 5 years. So cash flow. So I get coupon first year, coupon second year, I get coupon third year, I get coupon fourth year, I get coupon plus redemption value fifth year. Then you calculate the future value at maturity. Now, here, first year amount I receive the coupon, I invest in which bond? Not at YTM. I look at market. What are investable opportunities? Let me call it as cost of capital. This will be invested at the end of year 1 till year 5. So multiplied by 1 plus R to the power of 4. Because from year 1, I'll get only till year 5. So that is what you get one amount. Similarly, this at the end of year 2, you will invest till year 5. So you get for 3 years. Like that 2 year, 1 year 0. So you get 5 maturity values. This is one future value you get. The present value is nothing but market price. Number of years in this case is 5 years. So future compound interest, use the basic compound interest formula. Future value equals P into 1 plus R to the power of N. Future value is this maturity value. Present value is this market price. And number of year is the term. And R is what you're going to calculate becomes realized yield. And why it is called as realized yield? Because it is what it is actually realized. YTM assumes reinvestment at same rate. It's okay for assumption, but practically the rate of interest will change, and therefore when you make that modification, that is realized YTM. And let me tell you one secret which you should know. In fact, in the CA intermediate capital budgeting chapter, you had IRR, that is nothing but YTM. You had modified IRR. I'm sure many of you would have forgotten that modified IRR is nothing but realized YTM. So I hope I have addressed that thing. Please explain current yield. Okay, current yield is the simplest concept. When as an investor, what I'm expecting in the immediate next year. Immediate next year. That's what is current yield. So I make an investment of 1 lakh and next year I get coupon of 10,000. So 10,000 by 1 lakh, 10% I'm getting for next 1 year. And that is current yield. So simple formula for current yield is coupon divided by current market price into 100. The interpretation of the current yield is what is my return in percentage terms for the immediate next year. You know the formula for dividend yield? If I become a shareholder of a company, market price I'll have to invest, and what I get is dividend per share. So dividend yield, what is the formula? DPS by MPS into hundreds. That is means if I become a shareholder, what is my income in the next year in percentage terms? The same interpretation is current yield in bonds. Today market price is my investment. My coupon in the first year is my inflow. So coupon divided by investment, that the coupon by current market price is the formula for current. I hope you are able to get that. Value, YTM, realized YTM, duration, volatility, immunization, forward rate, convexity, horizon analysis, convertible bonds, refunding decisions. These concepts enough for bond valuation chapter. Yes, that's all the concept exists. What is required in bond valuation? concept of repurchase agreement, commercial paper, treasury bill, dirty price, clean price. Regarding this, I think one problem I've covered it. So please go through the video once more. There I've explained. And to explain the concept quickly for your reference, commercial paper is issued by companies, treasury bill is by government. Both are for less than 1 year maturity, so no question of any coupon will be there. You issue and they repay. The difference become your income divided by issue price investment. Then dirty price, green price. In IPCC you would have learned investment accounting. There's something called as X interest, cum interest. When you purchase a bond, interest accrued till date from the total transaction price, you take out that interest accrued. The remaining portion is actually towards the cost of the bond, X interest, that is called as clean price. The cum interest, by adding the interest accrued, that is called as dirty price. Interest in stock market, yes, those things I'll handle separately. I'll see what additional videos I can come up with and what additional guidelines that I can support. We'll handle that endeavor separately, but I'm sure I'm going to, please be assured, let me come up with something on that front. Difference between spot yield and forward rate. Spot yield, I'm sorry, I've not come across that term. There is term differentiate between yield and forward rate is there. Now, year one, I get, let's say 10%. Year two, I get 12%. So the 10% for year one, 12% for year two, that's called as forward rate. So forward rates are applicable for a particular year. But if I take both of them, what is the average rate, can I say? 10% plus 12% divided by 2. That average rate is called as yield. So yield is a rate of interest for certain number of years. This is the conceptual part. Calculation part, along with the concepts, I handled in the videos which I uploaded last week. You can refer to that. Explain about nominal rate and effective interest rates. Again, in the basics class, I would have covered, but still I quickly revise it. Let's see if you're able to follow it. This situation will arise when the interest rate is compounded more than once a year. 5%, let's say 10% per annum. Compounding. What do you mean by that? 100. On that 10, it becomes 110. On that 10, that is on 110, you apply 10%. That's compounding once a year. But what if you do compounding more than once a year? For example, 10% per annum compounded half yearly. So every 6 months once you calculate rate of interest. Let's start with 100. For 6 months, you apply 10%. How much you get? 5 rupees. 10% for 6 months means 5 rupees. On 105, for second half of year, on 105 you apply 10%. For 6 months, you get 5.25. Effectively, what you got? 5 and 5.25. So total, it is 10.25. So 10% per annum compounded quarterly effectively become 10.2. So 10% compounded half yearly effectively become 10.25 per annum. The 10% is called as nominal rate of interest, and 10.25 effectively converted into annual terms is called as effective rate of interest. When YTM is different from first year to second year, it is because of market price change. How do we estimate the market price, since it's based on demand and supply? Market price is based on demand and supply of what? Of rate of interest. So don't try to get confused between too many numbers, too many concepts. Keep it very simple. You are calculating YTM based on market price. Now, If you say I don't know market price, I cannot calculate YTM, it is one dependent on another. You can't keep both of them uncertain. Knowing today market price, you can calculate what is the YTM, assuming that market price is already there in the market. Bond replacement, convertible bonds. I have converted those. I have covered those concepts in my previous sessions, which I have uploaded this week. So please refer concepts there. I have explained along with the problems also. I have done. I have purchased SFM classes but not yet started. Can you please tell me from exam point of view for May 23 which class is better, YouTube or purchased one? Uh, from May 23 classes, since you are not yet to, if you are not yet to take any classes, if you are fresh for SFM, please go with these YouTube classes. No need to buy any of my classes. Not required, because May 23 you will not have time to go through my regular, comprehensive detailed class, because detailed class will go like 230 hours. I think I'm planning to upload more. So if you're, I recently cleared my CA Inter, shall I go for class? If you have time, at least let's say 12 months, then you can go with my purchased class. That is detailed one. You can go through it at your sufficient time. But if your examination is like 3-4 months away, do not use these YouTube. Do use only YouTube classes. Do not purchase my SFM class there. If you want FR class also will be available. Crash course freshly recorded along with amendments. You can go for it. When we can upload in Hegde's Hedge, I'm actually tied up with few things, so I could not come up with any updates for a couple of months. So let this free sessions get over. Maybe this February will take time, right? And after that, I'll start coming on the practical things being touched upon. Yeah, things Hindenburg will come, budget will come, Adani case will come. See, every day some news or the another will come. Even if I come, practical scenarios, I'm not going to go behind trending videos, because you go behind it, you don't learn anything. Do you remember 1 year back what was the trending topic? Have you learned anything? There were so many cases happened, but point is, every day something or the another will happen, but on a sustained basis, what you learn and what you apply, that is what going to be my target will be. So let this free sessions on YouTube get over. After that, I'll give you the updates on the Hegde set channel on practical aspects. Okay, I think I tried to cover free cash flows, FCFF, FCFE. That is part of equity valuation, which I will cover it in my next session. Whatever we have been solving so far, I think today or yesterday I've uploaded the video on dividend, market valuation, those kind of stuff. And FCFE, FCFF problems also will be done. Concepts also will be covered, like value of strategy, right shares, buyback. All those will be part of my corporate valuation chapter, which is planned for the coming week. Once it is done, then in the next week live session, I will address your doubts on free cash flow to equity and free cash flow to firm. Can we do it manually? What you have done in Excel in session 1, array formula, any formula. Sorry, I'm not get it. You want me to do it once more or something? Is that your question? Okay, you are qualified for cost accountant and third accountant. Yeah, that's very nice to hear. That's good. It's all your efforts, and it's great to you for solving for clearing both the exams. Bond and equity valuation will be 8 marks for sure. Yes, bond will be for 8 marks, equity valuation will be for 8 marks. And equity valuation is much broader than what people think. Equity means dividend will come, P ratios, multiple valuation multiple will come, dividend theories will come, right shares, buyback, bonus, promoters holding. I've covered all the varieties in my free sessions classes. All those things are FCFE, FCFF, DCF calculation. All these are part of equity valuation. Equity valuation is a much broader perspective, which I'll be uploading the videos in the coming few days. Meaning of spread in bond valuation, again it depends on the different context. The popular context what we use is the difference between the interest rates. If you need maybe 12% rate of interest when you borrow, and when you invest it might be only 8% rate of interest. Even if you go to bank, right, if you take a loan from bank, you have to pay like 12%. But if you keep a bank with FD rate, they'll give only like 8%. The balance is what popularly we use the word as spread. Money market instruments are short-term instruments. See, what we call about bonds, government securities are for more than 1 year. But commercial papers, treasury bills, RBI keeps issuing this, treasury bills for less than 1 year, investment for short-term period. That's called as money market instrument, having a maturity less than 365 days. RBI issues like, you know, uh, 91 days, 184 days, 365 days, like that. Opinion on November 22 paper can May 23. There is no specific opinion. It's a regular question paper. Sometimes some sudden, bouncer questions will come, and that is part of SFM or any subject for that matter. The only suggestion I always give, very simple: cover the basic concept problem wherever you attend the class and solve last maybe 10 years question paper, because it's exam question. If you can get confidence from exam question paper, nothing like that. Since you have old syllabus and new syllabus, you may well use of the opportunity of multiple papers as well. You can go with YouTube classes and Hegde such material. Yes, that's what you can go for it. And Hegde such material also is a comprehensive problem. So I should give you that clarification once, that the Hegde's Hedge book, what I'm sharing, is more of a compilation. It's not a textbook. So don't use it if you want any explanation of any topic or any concept. That is not there. So Hegde Set is a compiler of RTP, previous year question paper, old syllabus, new syllabus, MTP, that I've compiled and arranged in a logical sequence so that you can easily go one after the another. Logically constructed topic-wise problems are covered. It's not a concept book. It's not a textbook. What is the formula for future value of when monthly investment for 10 years? I'm not sure whether you're asking from practical perspective, because if practical, we have Excel formula. But anyway, if you want to know the future value of annuity, formula goes like this. Future value is annuity amounts into 1 plus r to the power of n minus 1 divided by I. Because you told rate of interest, you mean because you told it's monthly, so the rate of interest you can divide by 12, and the number of years you can multiply it by 12, so that both are expressed in number of years. So I'll just give the basic formula. For monthly, you divide the rate of interest by 12, n you multiply it by 12. If it's quarterly, rate of interest you divide by r, number of years you multiply it by, number of years you r you n you multiply by 4, rate of interest you divide by 4. And of course, Excel formula is there to get the answer practical. Okay. Okay. So I hope this live doubt clarification session was useful. I'm getting quite a few doubts in the chats. I would appreciate, if possible, try to fill up the form so that I can also come prepared. And if any specific problem is there, that also you can have it. Anyway, so please do join the Telegram channel for all the updates. You can search my name and you will get it. What material we should refer for May to the May 23 exam? The classes what is happening now, or if you have purchased my classes, the class material, that should be your first preference, and solve previous year question paper, maybe last 10 years paper. That's sufficient, nothing else. uh, Dirty price and all, I've already I mean, I have just talked about at the beginning that dirty price nothing but your come interest price including interest accrued. Okay. Okay, so if anything is there, you can please apply, I mean, you can have it get your doubts clarified in the Telegram channel. So till then, till next session, take care, see you, bye bye.